For years, the whole investment story in the cannabis sector has been, well, it's been defined by just waiting, right? Just this painful game, focused almost entirely on Washington, D.C., hoping for some big federal policy shift. But while, the entire market was staring at those delays, one of the big players, Tilray Brands, seems to have quietly executed a strategy that turns the focus completely overseas. Welcome to the Deep Dive. Today, we're going to unpack a recent analysis report that details Tilray Brands' Q2 fiscal 2026 results. Our mission isn't just to read you the numbers, but to find that hidden story the market is reportedly missing by just fixating on the U.S.
And it's a good time for it, because this Q2 report wasn't just okay, it showed massive operational success. Tilray reported a record revenue of $217.5 million for the quarter.
Wow.
Yeah, and that's a crucial data point. It's concrete proof that their whole diversification strategy is actually working. It's bringing in real money.
That $217.5 million figure is definitely an attention grabber. But the real hook, the thing that's driving this whole new conversation, is buried a little deeper. The analysis points to this staggering 36% year-over-year explosion in international cannabis revenue. So today we're going to dig into why this global shift matters so much right now, and why it might just change the whole game for investors tired of waiting on Washington.
Okay, let's unpack this. Before we really jump into the international side of things, we have to talk about the foundation, the financial bedrock. Because a great strategy needs strong execution, and that needs capital. So beyond that big revenue number, what are the hard financial facts from this report that really set the stage?
Right, and the analysis really zeroes in on two critical health indicators here. It shows this isn't just, growth for the sake of growth. The first one is profitability. Adjusted EBITDA, which is basically a measure of cash operating profit, it came in positive at $8.4 million.
And in this industry, positive is a big deal. A very big deal. So many competitors are still just burning through cash. So to generate positive earnings from your core business, that proves you're efficient. But the second metric is, I think, even more powerful for where they're heading, their cash position. The report confirmed the company is now net cash positive.
Okay, so for everyone listening, what does that actually mean?
It means their cash on hand and their short-term assets are greater than their total debt. It's incredibly rare in the sector.
So they're not worried about running out of money.
Exactly. No liquidity fears, and maybe more importantly, they have what the analysis calls a war chest.
A war chest. I like that.
Yeah, it's stable capital they can use to invest, to get licenses, or even to, opportunistically acquire competitors who are struggling.
That context is so important. It means this whole global expansion isn't being funded by risky debt. It confirms their strategy is actually producing the security they need to beat expectations. It's really the fuel for the rocket, isn't it?
It is.
So now that we know they have the financial muscle, let's talk about where they're flexing it. Let's focus completely on that 36% jump in international cannabis revenue.
Yeah.
36% year over year isn't just growth, it's explosive. Where is this actually coming from?
Well, it's not scattered all over the place. It's geographically specific and very strategic. The report identifies that the heavy lifting, as they call it, is being done primarily through two markets, Germany and Australia.
And these are established medical markets, right? Not just speculative.
Exactly. These are markets with clear rules. They require serious regulatory navigation and certified distribution pipelines, which Tilray got into early. They already have that infrastructure. And what's really interesting here is the bigger picture on Europe. The analysis kind of frames the continent as a region that's finally waking up to regulated cannabis. And the report's conclusion on this is really clear. It calls Tilray the #1 player in that European region. This isn't just about selling a product, it's about controlling the entire pipeline.
So this isn't just a case of selling a little more volume. The analysis argues that the company is sort of shifting its identity from being a traditional cannabis company to something it calls a global logistics powerhouse. Can you explain what the report means by that?
Absolutely. When they say global logistics powerhouse, it means they've used their early licenses to build this reliable, compliant supply chain that spans continents. They own the cultivation, the processing, the regulatory pathways, and the distribution needed to get product from their facilities to, say, a pharmacy shelf in Germany.
So they control the whole journey.
The whole journey. They're capitalizing on having the licenses to control the supply chain, which gives them this huge competitive advantage over rivals who are still, just trying to get basic import permits.
That shift in identity is fascinating, from a U.S. hope to a global logistics powerhouse. But let's look at this critically. Why does the report put so much emphasis on these global medical markets over the U.S.? The U.S. market is massive. What's the real advantage of focusing on Germany over, say, New York?
You have to contrast the two environments to really get it. And the differences are, well, they're stark, especially when you talk about price. The U.S. market, as it is right now, is incredibly crowded and price compressed.
A race to the bottom.
It really is. State-by-state legalization has led to oversupply, so producers are in this knife fight where margins can just collapse to like 15% or even less. Now, compare that to the European medical markets where Tilray is the dominant player. There, you have significantly higher margins and, crucially, much lower competition. The barrier to entry in Europe isn't price, it's regulatory complexity and the scarcity of those import licenses.
Which Tilray already has.
Which Tilray has. So their margins in these channels can still be around 40, even 50%. That's a whole different ballgame for profitability.
It sounds like while U.S. companies are fighting for inches in a crowded room, Tilray is out on the European frontier, securing massive territory where the rules actually favor profitability. So to summarize a core idea for you, when you look at the stock, TLRY, through this lens, the analysis is saying you're buying the dominant global leader in medical cannabis logistics. You're not just buying another U.S. company that's waiting on a regulatory change that could be years away. It's a shift from speculation to execution.
And that 36% growth rate isn't seen as a one-time thing. It's seen as a trajectory. The report mentions there's significant expansion potential to keep this going. For instance, the German medical market is getting bigger, and new pilot programs are starting in other EU countries. If the analysis is right, this 36% is just the beginning of their European land grab.
Okay, so we've established the numbers look strong, the strategy is clear, and the international execution is delivering this massive growth. But financial markets, as we know, rarely move in a straight line. So what did the market reaction actually look like after the report?
The analysis mentions some serious volatility. It was a classic buy the rumor, sell the news event, a textbook example. Right after the strong earnings came out, the stock popped. It went up to a high of $10.05.
Which shows people like the numbers initially.
For sure. But then, almost as quickly, it reversed. The stock flushed all the way down to $9.18.
And that kind of rapid drop can really spook people, right? You see good fundamentals, but the price is falling. What does the analysis say caused that?
The report attributes it mainly to classic profit-taking. You have traders who bought in the days before the report, guessing the news would be good. The moment the numbers hit, they sell to lock in their quick gains. And that wave of selling just temporarily pushes the price down. It clears out the fast money.
And that's where the technical perspective from the analysis comes in, to understand if there's real stability underneath that noise. What did the chart show after all that selling?
It highlights two really crucial technical points that suggest there's underlying strength. First, the stock decisively held the $9 support level.
It found a floor.
It found a floor, which suggests that the bigger long-term investors, the ones who believe in this global story, stepped in to defend that price. And second, after that sell-off, the stock is now consolidating and its RSI is resetting.
Okay, for those not deep into technicals, what does a resetting RSI mean?
The RSI, the Relative Strength Index, it just gauges if a stock is overbought or oversold. A reset means it's not overheated anymore. It basically has technical room to make the next move up.
So the argument from the analysis is that the volatility was just short-term noise, just shaking out the weak hands.
Exactly. The report's conclusion is clearly bullish on this. It views this dip below $9.50 as a golden opportunity for anyone who believes in the global thesis. It claims the broader market is still sleeping on the international numbers and is too focused on that short-term noise. They see a technical setup that is primed for the next leg up towards $12, and it's all supported by that undeniable operational strength we talked about.
That brings us to the end of our breakdown. The final summary for you to take away is this huge shift in focus that the company is executing and that the analysis is really highlighting. It's a pivot away from the slow, low-margin U.S. story and squarely toward these established, higher-margin international medical markets. And this whole pivot is supported by strong Q2 financials, especially that positive operating profit and becoming net cash positive.
Yeah, and if we connect this all back to the bigger picture, that consolidation we've seen in the stock is key. We're basically waiting for confirmation that the market is ready to buy into this global growth story over the old U.S. waiting game. The analysis report specifically pointed to the $9.12 level as a really crucial point to watch, a sign that stable support is being built after all that volatility.
And here is a provocative thought for you to explore as you continue to track this global growth story. If, as the report suggests, this expansion is truly entering a land grab phase in Europe, a race to secure the best distribution and patient access, how might being net cash positive let Tilray accelerate its dominance? I mean, compared to competitors who are less financially secure, this financial strength lets them make acquisitions, bid aggressively on government contracts, or just invest heavily in local infrastructure right now. This ability to spend could accelerate their market capture far beyond what even that 36% growth rate suggests. It's the strategic advantage of the war chest.